This conference will now be recorded.
Good morning, everyone, and welcome back to a fresh new session on IFRS 9 impairment model development and validation sessions. In today's discussion, today, as we had discussed previously the last week, there would be no discussion on credit risk modeling this week. Instead, we'll have an extended discussion on the IFRS 9 impairment model development and validation, right? So today and tomorrow, it's all about IFRS 9, right? So we'll walk. We'll talk about these sessions in detail. So we will talk about every nuances of IFRS 9 in details today, right? Before I just move on very quickly, just let me recapitulate the discussions that we had in the last session, and from there we will take it up. With the last couple of sessions, we had started exploring the framework, the skeleton of IFRS 9, right? So we started talking about different kinds of we started our discussion different kind of asset classes, right? And we saw how is it differently treated under Basel and how is it differently treated under IFRS 9. So over here, what we did is what we tried doing is the following. So we have been taking up a single product. We took up the personal loans product, right, which was a term loan product, which was an unsecured product, and from there we looked into its asset classification, and we saw that it belongs to the asset which is it's an asset under amortized cost because it has an amortization schedule, and its payment contains solely a principal and interest. So therefore, from that perspective, what we have is we have the amortization, which is your so we have a sole payment of principal and interest, SPPI, right? So we saw that the personal loans satisfy the SPPI criteria, and hence this SPPI criteria is used, so therefore the impairment analysis for personal loans can be done within the domains of IFRS 9, right? So that's so this is the thing that we have been discussing in the last session. Now after this, now after this, the next thing that we started talking about in the last session was about the kind of the default definition. So we first started talking about impairment. So what exactly is impairment, right? So basically, we classify an asset as an impaired asset if it has hit its bad definition, right? Now, talking about the bad definition, we kind of had our discussion around two things. So we kind of had our discussions around like what is a bad, or when does a borrower become a bad borrower, and what exactly is the difference between the bad borrowers or definition of bad in Basel and definition of bad in IFRS 9, right? So one thing that we saw was that given that Basel models are capital models, that is, they are kind of used to ensure that the model is or that the bank keeps an adequate amount of capital with them, right? So they are very stringent in terms of your definitions. It needs to ensure that the bad definitions. If I talk about the bad definition of the bank, right? The bank knows that the bad definition that I'm talking about is the bad borrower that I'm talking about is a borrower who should be identified as bad in a very conservative manner, because there are a lot of different risks involved with that if the bad definition is not very stringent and conservative in nature. So, given that Basel models are capital adequacy models or given that they are capital accords, which are used for or which are used always become critical to absorb the unexpected losses, right? They are very stringent in terms of the definition. But the IFRS 9 regulations, as we saw, as an impairment regulation, is not that stringent. So the bad definition that both of these two regulations give us is the same. Both of them say that in a retail portfolio, right, that a borrower is a bad borrower or borrower becomes bad if he is 90 days past due. So if the borrower has been missing out his payments or his EMI for 3 or more consecutive months, he is flagged as a bad borrower, right, or an impaired borrower. But but IFRS 9 not only applies to retail and commercial products, so there are a lot of different other products which are there. So we come down to each of these products one by one going forward. So over here, when this, when we look into this, the range of product to which IFRS 9 is applied, right? IFRS 9 cannot be such stringent about the bad definition. So what IFRS 9 does is IFRS 9 says that okay, a borrower is a bad borrower if he is 90 days past due in terms of his payments. And to that, they bring in a rebuttal analysis. So what they tell us is I'm saying that it's 90 days past due, right? But your portfolio may be something different. So that is where you can rebut the analysis, or you can rebut my bad definition with an appropriate analysis, right? So if you think that your bad definition is something other than 90 plus, then you can perform a rebuttal analysis and you can rebut the fact that bad is 90 days past due, because many commercial portfolios have bads as 180 plus 365 days plus due. So basically, there are business contracts where the people say that okay, we will be paying the money back to you 1 year down the line, or let's say there are some bonds held for sale whose returns are due 1 year down the line. So in such a case, if the bond defaults, the default has to be happen within the next 1 year, right? So the money doesn't come in an installment, but what it comprises of is it comprises of principal and interest, which is made the payment of which is made only after maturity, right? So that's where the rebuttal analysis comes in, so that I can rebut the fact that excuse me. So I can rebut the fact that okay, this borrower, so this portfolio of mine has a separate bad definition. So for that, I need to provide supporting analysis. I need to provide supporting analysis, and I need to show that yes, these borrowers are, or this portfolio that I have has a bad definition, which is other than 90 days plus 90 plus DPD. So I need to have a supporting analysis, right? So this is some. So we'll be talking more about rebuttal analysis. However, if I am to talk about personal loans, 90 days past due is a very common definition, right? If a borrower has flown into the fourth cycle of delinquency, then he is more or less a bad borrower because he's not been paying back for 3 months and hence he's a defaulter, right? So over here, just before I move on, so there was a kind of confusion in the last class. So I'll just clarify that once again. That defaulting is not delinquency. Delinquency arises when a borrower misses out on a payment, right? So if as a borrower I miss out paying an installment, I become delinquent, right? Now, an event of continuous delinquency, I don't pay back my interest for my pay back my EMI for 1 month. They call me up. I tell them I'll pay them the next month like this. So a period of persistent delinquency is bad or is default, right? So default, and I'll just put this a period of persistent delinquency is default, right? Now, previously, what used to happen under IAS 39 standards is that all your provisions, right? So all your provisions used to be kept only after the losses have happened. So they were a kind of incurred loss approach. So only after you have been delinquent at a stretch for 3 4 months, and then you put up your hand saying that, man, I am a defaulter, that you are treated as a defaulter, right? So this is so this is where uh, IS 39 standards came from, right? And that was the incurred loss approach, which was previously used for provisioning. Now, IFRS 9 focuses on the journey of the borrower from delinquency through the period of sustained delinquency to default. So, a period of sustained delinquency is your default. Sustained delinquency is default. Right now, IFRS under IFRS 9, we would what we do is we trace this entire journey from being delinquent to default, right? And that journey is traced using something called the staging. It's something called the staging approach. The staging approach. Right? So this is what we had discussed till the last class. Not this, but we had discussed the staging as well. So this is broadly the elements of discussion in the last class. Right? So now IFRS 9 talks the about dividing the borrower's behavior into 3 stages, right? And it is this staging approach which makes this model or this framework very predictive in nature and very forward looking in nature, right? Now, depending on whether the borrower is in stage one, right, or in not stage one, right, the ECL measures are computed. Let's say that, so what is stage one? What type of borrowers are there in stage one? Borrowers in stage one are non-delinquent and active borrowers. So these are essentially your CD0 borrower. Borrowers who are in their 0th cycle of delinquency. That is, they are not delinquent. Now, borrowers in stage two are borrowers who have become delinquent and whose credit risk has significantly increased. So these borrowers are borrowers, the borrowers in stage two or the accounts in stage two are accounts which have become delinquent, right? So which have become delinquent, but what happens is in stage two, they do not actually, so what happens over here is that in under stage two, they do not they're not impaired, but what has happened is they have undergone a significant increase in credit risk, and that's why they have been degraded to stage 2. The moment they have been degraded to stage 2, you know that there is an element of increased riskiness in them. So the question that comes down to is that after what stage, after what increase in the credit risk do I call it as a significant increase in credit risk? How do I identify my significant increase in credit risk? And when I apply my SICR, that becomes my staging criteria. Now, for accounts which are in stage 2, we will be computing the lifetime expected credit losses. And this is where IFRS 9 has a great contribution from the other provisioning, the historical provisioning models. It is not only using the next 12 months loss. So if it says that, okay, if your account is not if it's not delinquent, for all your non-delinquent accounts, your low risk accounts, what you will do is you will compute the next 12 months expected credit loss. However, if your borrower is in stage 2 or stage 3, you will compute a lifetime expected credit loss, right? So this diversification in the two definitions of expected credit losses is your stage 1. It's the biggest contribution of IFRS 9, the staging and these two definitions of expected credit losses, because they add on an element of conservativeness to the model. So what they say is that when you are a non-delinquent account, so you have been paying your EMIs very diligently over a period of time. Now you increase that, right? So you have been paying that over a period of time. So you are non-delinquent, right? So you have never missed out your payments. So therefore you are a stage 1 borrower. Now let's say you were paying it back in time, so you are stage 1. Now you miss out 2 EMIs. The moment you miss out that, you are demoted to stage 2 because you have now become delinquent. And a delinquent borrower at a given point of time is always more risky than a non-delinquent borrower. And then what comes is stage 3, which is the final impairment stage. Accounts flow from stage 2 to stage 3 when the delinquency becomes so sustained that the bad definition gets accustomed. Right? So this is precisely what the broad idea is. Right? Now comes the next part. The next part is that how do I identify the significant increase in credit risk, and how do I know that what is that point when I need to demote an account from stage 1 to stage 2? That is where the staging criteria comes in, and the definition of significant increase in credit risk also comes in, right? Now the question that comes out is that how do I identify, what are the criteria of identifying a significant increase in credit risk? So one way to identify this significant increase in credit risk is to compare. So to identify this, so one way to do this is to compare the risk at origination. To compare the origination risk or the riskiness of the borrower at origination relative to the current riskiness. To compare the origination risk to the behavior risk. To the behavior risk. Behavior risk at that given point in time. So over here, we need to talk about two types of risks. One is origination risk. So the question that comes out is that how do we capture the origination risk? Right? So that's one part. The second question that comes out is that how do we capture the behavior risk? So how do we do this? This is what we need to understand. Right. So what I have is the origination risk and what I have is the behavior risk.
Tanmay, a quick question. Accounts that have moved into stage two, can they move back to stage one, or
Yeah,
once
yeah,
it
they
can,
can
right?
move to stage one. So that's called the derecognition of an account. I'll come back to that later. I'll just come back.
Sure.
Yeah, so let me just first talk about the flow from 1 to 2 there and 2 to 3, then I'll talk about the reverse flow guys. I'll come back to that. Okay, so the question that comes over here is how do we capture origination risk? Right? Now, a very simple way to capture origination risk or a very standard way of capturing origination risk is through origination scorecards or as we call it acquisition scorecards. So when you are acquiring the borrower, right, what you are trying to understand is that what are the chances of the borrower of being a good borrower. So it's acquisition scorecards. Is acquisition scorecards. So what does the acquisition scorecard tell us? Or what is it that we are trying to do through an acquisition scorecards? So like in the last class we talked about it. Let's say the dependent variable in my acquisition scorecard is something like this. It's y equal to 1 if the borrower is good. So I create my dependent variable like this. If the borrower is good in the next 12 months or is good, let's say I have a good definition. I have a definition of a good and I have a definition of a bad borrower. And that good and bad definition is created from the roll rate analysis, which we had discussed previously. We'll come back to that once again. That how is good defined, how is bad defined. We'll come back to that. And y equal to 0 otherwise. So these are the two possible outcomes. So basically at acquisition, when I'm acquiring a borrower on my books, right? So a borrower comes up to me asking for a loan. Now it's my choice whether to give him the loan or not. So I need to decide because every time I acquire a borrower on books, there are two impacts that happen. One is the impact on my total growth in terms of receivables, in terms of profitability. That's one. And the second is on my RWA. So basically, whenever a bank is growing, the bank always has to have a trade off between RWA and the profitability. Right? So if I'm actually acquiring a borrower on books, I need to understand that what is the impact on RWA and what is the impact on the profitability. So I need to have some kind of a decision mechanism, and that decision mechanism is provided by acquisition scorecards. And acquisition scorecards, so what are the outputs of and what is the output of an acquisition scorecard? The output of an acquisition scorecard is an acquisition score. So it's a acquisition score, right? So when the bank uses this acquisition score, so every score has so there are always two types of score. One is score which is the cutoff score, which is S bar. The second is your S0, which is the score of the obligor. O stands for obligor. Now, if the score obtained by the obligor is greater than the cutoff score, then what we'll say is that, so when if the score cutoff score is greater, I mean S0 is greater than S bar, then the borrower is generally accepted, right? It is accepted. If it is not, then it is declined. Right? So this is what the concept of an acquisition scorecard is. But what lies at the very base of acquisition scorecard? So what are we actually doing? From where do we get the scores? So what we do is the scores are nothing but their transformation of the probabilities. So from using an acquisition scorecard or using the model, acquisition model, all we try to do is we try to predict the probability of y equals to 1, right? So talking about the probability of y equals to 1. So it is the probability that the borrower is good. Now the next thing that I estimate over here is 1 minus the probability of y equals to 1, which is the probability of a borrower being bad. So which is over here the probability of y equal to 0. Now this probability of y equal to 0 is nothing but this is your acquisition PD, or as we call it, your origination PD. It is your origination. Right? So this is your origination period. So when I'm giving you the loan, you have a certain amount of probability of default. So that's your origination period. Now let's say, assume that you have been given the loan, right? Now what I start doing is I start monitoring the loan. So what is the probability that the borrower defaults given that he has been accepted and he has been given the loan, right? So that is your behavior PD. Now to assess that behavior risk, so once the borrower has been given, so there are different account management teams who monitor the accounts, right? Their payment behaviors, their delinquency patterns, and everything. And from there, what we generally try to develop is a behavior scorecard or a behavioral model. So we develop behavior scorecards. Now, the scores that we generate for behavior, be it for behavior scorecard, acquisition scorecards, I'll show it to you how they work shortly, right? So what I'll do is I'll have called a behavior scorecard, right? So we use the behavior scorecards. Now, the scores in a behavior scorecards are generated basis the probability of, generated basis the calculated probability of default. Now, in behavior scorecards, the dependent variable will be y equals to 1 if the borrower defaults equal to 0 otherwise. So these are the two parts, right? So behavior scorecard, so y equal to 1 if this is that, equal to 0 otherwise. Now from here, so when I work with this, I'll get a probability of a borrower to default. The probability of borrower to default in the next 12 months. So this is the probability of y equals to 1. So this probability y equals to 1 is called my behavior PD. Called my behavior PD. Right? Now, if after a point of time, let's say I run my model every month or I run my model every quarter, right? So at the time of running for each of the accounts, if I see that the behavior PD is greater than the acquisition PD, right? Then I can say that the riskiness of the borrower has increased, right? So there has been a significant increase in credit risk if the behavior PD is greater than the acquisition PD, right? So this is the case where it is. So this is SICR, right? So behavior PD is greater than the acquisition. So this is one criteria for identifying the significant increase in credit risk. Now over here, since I'm talking about this, right? So we need to know how is this scoring scorecards, this behavior PD, acquisition PD are related to each other. So before we go into a deep dive of this exercise, can you just so if there are questions, you can just clarify it at this stage, and then we can move ahead.
What is IAS 39 standard? Can you come again on this?
Okay, so IAS 39 standards are, I mean, these are, so this is an incurred loss provisioning standard, right? So which considered the incurred loss models. So basically, it talks about impairment provision. So once an account has been impaired, how should you be provisioning it, right? So it was a very adaptive method. It was not predictive in nature, and hence that was replaced by IFRS9. So we'll come to the standards in details, right? So I'll come to IS 39 versus IFRS 13, IFRS 9. We'll talk about the impact analysis and so on, right? But so first, let me just complete the framework of IFRS 9. Then I'll take up IS 39, and then we'll enter into the comparison impact analysis, because impact analysis is something which is really important for IS 39 and IFRS. So we come to that impact analysis portion, and then we'll talk about IS 39 standards in details. Okay, I think Nehal has a question over here, and Piyush has a question. I'll just take up these two questions. Till then, you can keep on putting in your questions. Okay, so Nehal has a question that behavior PD at what stage, at what month on books? Okay, so I'll come back to your question, Nehal, in short time, right? So this is the point that I'll address while I talk about using this as a significant increase in credit risk criteria. So there are certain challenges, and that is where the month on books will come in. I'll come back to that. Okay, so Piyush has a question: is an underwriting scorecard and application scorecard the same? Yes, Piyush, an underwriting scorecard and application scorecard are same. So these are known as underwriting models. Right? Pradeep, Anshul, Toon, any questions, anything that you may not have understood, you want me to reiterate again? Because Anshul and Pradeep was there in the last session too. You were not there. So
Hello, Tanmay, can you hear me?
yeah, Anshul, tell me. So is there
Yeah.
Uma? Oh, Piyush.
Hello.
Yeah, Piyush, tell me. Yeah.
Yeah. What I was trying to say is, so like we will have stage one, stage two, and stage three customers uh, at an observed state, and the model will also predict that whether they have shifted right from one stage to the another. So we will
Yeah.
know.
So basically, let's say I'm running my ECL model, my IFRS and impairment model in the month of January 2019. Okay. So January end, I'm running my model. So I'll get a composition of the borrowers who are in stage one, stage two, and stage three. I'll get that distribution, right?
Mhm.
Now, for each of them, I'll compute my ECL and I'll get my provision. Now, what I do is I again run the model in March. Now, when I run the model in March, some of the stage one accounts will have migrated to stage two. Some of the stage two accounts will have migrated back to stage one. Some of the stage two accounts will move to stage three, and so on. So then again, when I run the model at the end of March, I'll get a different distribution to the stage one and stage two, stage three, right?
Right.
So staging is an observed phenomenon. So as on that, as at the time, as of the reporting date, when I'm executing the model, right, or when I'm running the model, I want to know what is the distribution of these stage one, two, and three. So how does it work? So that is what I want to know. So it is an observed state. Now, for those accounts which are in stage one, what are their probabilities of defaulting in the next 12 months? What are for accounts which are in stage two? What are their lifetime expected credit losses? However, in industry practice, when we do it, for all the stages, we compute the next 12 months loss and we compute the lifetime losses. But when we use it in the model, we use the next 12 months for stage one, and for stage two and stage three, we use the lifetime ECL. But for each of the stages, we compute both the figures.
Okay. Thank you.
Okay. Okay. Toon, are you clear with this? With each of the concepts? Perfect. Great. Now, now there are a few questions that we need to talk about. The first question that we need to talk about is we need to talk about rather some very critical concepts about acquisition scorecards and behavior scorecards to understand the challenges that may crop up if I use behavior PDA versus acquisition PD as my significant increase in credit risk criteria. So how do I do that? So that's the question that we have over here, right? So let's say, let's look at it this way. Uh, So let's first see how acquisition scorecard works, right? How would I take a decision using an acquisition scorecard? So just excuse me. Okay. Okay. So this is how I would look into an acquisition. So this is an arbitrary example of an acquisition scorecard, how an acquisition scorecard works. Right? So this is something we have already discussed in our credit risk modeling session, but for the new audience, I just just go through it once. Okay, let's say the business problem is that there is a Mr. A. So there is an obligor Mr. A who comes applying for a personal loan. Right? Now he applies for a personal loan of rupees 10 lakhs and obligor status is salary. So basically Mr. A is a salaried guy who is looking for a personal loan of 10 lakhs. Right? Now over here what we have is we have the overdraft account status. Right? So now basically the question is that I need to decide whether I should give him a loan or not. Now, how do I decide? I decide in some terms of some key matrices which are proposed by my scorecard, and this is how my scorecard looks like. Now, the question that comes out is that how do we reach to these factors? So that is where the development of an application scorecard comes into play, right? So which we will be discussing. So over here, when I talk about the development of an application scorecard, or I talk about the development of a behavior scorecard, so we will come to that. But so after assuming that a model has been developed and the final scorecard has been reached, right? Now what we do is we have a set of key factors that has been proposed by the scorecard. Now, something which is very important to identify over here is the type of factors that are being used to take the decision, right? So this is an arbitrary scorecard that I had created for an example, but the type of variables that we finally select or that finally that we reach out are more or less similar, right? Or the type of aspects of riskiness of a borrower that it captures is more or less similar. Let's say over here, so over here there are 4 risk determinants. One risk determinant over here you can see is the overdraft account status of the borrower. So if Mr. A is applying for a loan, right, with this bank, what the bank sees is that okay, there is an overdraft account, whether this borrower has an overdraft account with him or not, or OD account with him or not. The next is it looks into his savings account status. Third is it looks into its fixed obligation to income ratio. And the fourth is it looks at number of inquiries made by the customers for the product. So let's say the bank looks into these 4 matrices. Now the question that comes out is that you would ask me that why is it that you are using these matrices? So the first case we talk about the overdraft account status. Now in this overdraft account status, so this is a kind of a reliability metric of the borrower basis his previous credit consumption patterns, right? So let's see, let's say this guy has an overdraft account, right? Now what are the possibilities? One possibility is that the borrower does not have an overdraft account. Now that is the safest guy. If a guy does not have an overdraft account, he is the safest guy. Now, the second possibility is he may have a overdraft account. Now, if he has an overdraft account, then what are the different possibilities? First possibility is that he may have an overdraft account. So he always overdraws his money, and he does not pay it back in time, and hence he's overdrawn most of the time. So that means this is a overdrawn. So this borrower has a tendency, a borrower who has, a overdrawn current account, overdraft balance, is a borrower who takes the money or credit. He has a huge credit consumption, but he does not pay back the money in time. So this is a very risky borrower. Now, if I have such risky borrowers, I will not be willing to give him a personal loan, because very simply he may take the personal loan and not return it back to me in time. So that is where the overdrawn balance comes into account, right? So what we have over here is the scores. So basically overdrawn balance account with an overdrawn balance is assigned the score 0. Now the next question that we come to over here is okay, now let's say okay, the second case is where this guy has a current account, I mean has an overdraft account. It has a category, right? 0 to 20,000. 0 to let's say 20,000. So what I'm saying is this guy has a current account, right? Has an overdraft account, but he maintains a positive balance in that. He maintains a low positive balance, but he is not overdrawn. So I assign a relatively higher score is assigned to this borrower. Now a borrower who has a balance greater than 20,000, that means he has a relatively higher balance, and hence the score assigned to him is relatively higher. But the highest score is given to the borrower who does not have an overdraft account because he's the safest of all. Now the question is that what is the difference between these two group of borrowers and this borrower who does not have an overdraft account? Because one thing common between the three of them is that none of them are overdrawn. Now it can be that this guy, these the people or the accounts falling in these two groups, 0 to 20,000 and greater than 20,000 are borrowers who have an overdraft account. They maintain a positive balance, but at any time they can overdraw that. So they have the provision to overdraw that. Now let's say that I give a personal loan to him or her, right? Now what I see is that this borrower takes a personal loan of say 3 lakhs, right? Now after a point of time, like say after paying back 2 lakhs of thing, right? What happens is he loses his job, his credit and his repayment capability undergoes a deterioration. So what he can easily do is he can pull money from his overdraft, he can overdraw his OD account, and he can use that amount to pay back your, and he can actually use that amount to pay off the personal loan. And then even though he does not go delinquent or he does not default on the personal loan, he may default on the overdraft account. Now the APR on an overdraft account is much higher than on a personal loan. Hence, a bank giving this also runs an implicit risk of a greater exposure in terms of interest in the future. So borrowers with overdraft account, but borrowers who maintain positive balance in their overdraft account is relatively less risky than borrowers who are overdrawn, right? So I may think of giving them the loan, but I would be apprehensive. So I would just be very happy to give a loan to a guy who does not have the OD account at all, right? So that's the reason, or that's the business logic of the ordinal ranking of the scores. Now when the scores are given, right, when the scores are given, what happens? That you see that they either increase or they decrease monotonically, because these categories that you create are ordered according to their relative riskiness, right? Now the question, and so finally what we do is we look into the business rationale of choosing overdraft account status as a variable in the scorecard. Now why is it being chosen? So basically, the overdraft history will give us an idea about the borrower's historic lending tendencies in the bank. Now, if a borrower has overdraft, he takes money, doesn't pay back, has gone delinquent multiple times, or has come close to defaulting and then gone back, it means that any stress happens and he's just out of it. So the overdraft history will give us the idea of the borrower's historic lending tendencies, right? So this is an index of the borrower's reliability. So when I'm actually acquiring a borrower, right, I look into his reliability as a borrower. So how reliable is this borrower? Now he maintains an overdraft account, he can afford that, but how reliable is he with that account, right? So this overdraft account status has been incorporated into the model to capture the reliability of the borrower. So the next part that we have over here is the savings account status as a second variable. Now, what does savings account status? And a savings account status is there, right? Now, why savings account? Now, savings account is something which is a savings account status is something which is uh, a measure of an affordability of the borrower. Now, the amount of balance that this borrower has with him in the savings account will speak about how or how much of money the borrower has, how or what extent of saving tendency this borrower has. Now, borrowers who have a distinct saving tendency, right, are borrowers. Now, borrowers who have a distinct savings tendency are borrowers who have, so these are so these borrowers are distinct saving tendencies, or borrowers with distinct savings tendencies are borrowers who are relatively less risky, because you know that there are savings accounts. So there are borrowers who have savings, right? So who has good savings. So the bank knows that even if this borrower loses his job, he has sufficient amount of affordability, or he can afford the product. He'll not be going delinquent. So savings account balances are a true indication of a borrower's affordability for a given product, right? So the savings balance of a borrower is an important affordability metric. A borrower who has a relatively higher savings account balance is considered to be a less risky borrower, because in the event of a degradation in his repayment capacity, he would have the savings balance with him to repay the debts. Right. So this is something which is important. So such repayment capabilities would be lower for borrowers with lower savings balances, and that is the reason why this variable is so important. So it's an affordability metric, and you'll see that from borrowers who do not have any savings balance, they are given the lowest scores, and the scores increase as the average savings balance increases, right? So let's say a borrower who does not have an overdraft account and has savings greater than 50,000 is the best that the bank can hope for, right? So then they'll get the best of the scores. So any acquisition scorecard looks into the borrower's acquisition and into the affordability, the reliability matrices of the borrower, right? And the borrower's probability to default, or the probability of being a good borrower, is contingent on these variables, right? The next is the fixed obligation to income ratio. The question that comes out is, what is fixed obligation to income ratio? Now, now generally when we earn income, right? So our disposable income, from our disposable income, there are certain fixed obligations that we need to pay out every month, right? So that we need to pay out every month. Now, when we pay out every month, so what is it that we do? So basically, let's say I have an electricity bill to pay, I have my all my bills to pay. So that's a fixed obligation. To that, if I have taken any previous credit, I have to pay an EMI. So that's again a fixed obligation. So the fixed obligation to income ratio is something which will give the bank an idea about the actual affordability of the borrower. Let's say there is a borrower who earns 60,000 rupees a month and a borrower who earns 1 lakh rupees a month, right? And both of them have a fixed monthly expenditure of 30,000 bucks. So the free income of the first borrower who earns 60,000 is 30,000, and for this guy it is 70,000. Now the borrower who has an EMI of 1 lakh also has a mortgage loans against his name, right? And for that, what he is doing is he is actually paying an EMI of 40,000 a month. So now his expenditure 30,000, his salary is 40, his obligation is 40,000, and his free disposable income, or his free income, is 30,000. Now the borrower who earns an income of 60,000 and has a monthly expenditure of 30,000, he also has a a free income of 30,000. Now, if both these two guys go up to the bank asking for a loan, the bank would always prefer to give a loan to the guy with 60,000, because what they will say is that to the guy who earns rupees 1 lakh, they will say that you already have a fixed obligation of 0.7. So this guy will fall over here. He will get a score of 30. Whereas the other guy who has a fixed expenditure of 30,000, so he'll fall under the category 0.1 to 0.5, and he will get the score of 38. So the guy who earns lower income but has a lower fixed obligation to income ratio will be the guy who would get the greater score. Now, why is again this so? Because this fixed obligation to income ratio talks about your affordability. The more your income is booked up with fixed obligations, you know that it is very difficult for you to fetch out more money for other EMIs. So if your fixed obligation ratio is higher relative to your overall income, you know that you are in a so your fixed free income is relatively lower, and in that case you would know that this fixed obligation to income ratio would give you an element of the reliability of the borrower as well as his affordability. So lower the fixed obligation to income ratio is, higher is the free income, greater is the affordability, right? So that is the reason why you will see that as the fixed obligation income ratio increases, the score decreases, right? So one thing you can look into is that all the variables that I am choosing over here are variables or are being chosen because each of these variables are, you know, kind of reliable, like, so they either capture the reliability of the borrower or they capture the affordability of the borrower, right? So are you clear about the type of variables that are looked into while you are developing an acquisition scorecard? Okay. So Piyush has a question over here. Says so he asks that does the scores originate from model variable coefficients and intercept? Yes, but there is a different way. So these scores are mapped to the log of odds, right? So once you compare it to the log of odds, you'll see that. So once you these are compared to the log of odds, and then the scoring is done. So I'll come to that. The probability of y equals to 1 and y equal to 0 comes from the coefficient of these variables. So I'll come to that structure a little later, not right now, right? Okay. So Toon also has a question over here, that this explanation is in relation to retail accounts. Are you going to speak about wholesale and corporates? Yeah. So to your question, yes, we will be talking about retail, wholesale and retail corporates as well. So we just started off with retail, right? So we'll talk about retail. I'll talk about personal loans in retail. I'll talk about mortgages in retail. I'll talk about revolving products in retail. Then we'll go to talk about the wholesale or the corporate products. We'll talk about SMEs. We'll talk about trade receivables. So we'll be talking a lot about these uh, wholesale and corporate products, right? So we'll talk about ratings. We'll talk about how this. So over here, you can see that in retail, I'm using the DPDs, right, to or the days past due to identify the significant increase in credit risk. Now, in wholesale and corporates, or even in for SMEs, wholesale corporates, etc., we will be talking about, we'll be looking into the ratings at acquisition, the ratings at the behavior, a degradation in the ratings from say triple A plus to double A minus and all these. So we will be coming to talk about each of these ratings for we'll come to talk about these ratings for the wholesale and the corporates. Okay, fine. So now the question that comes out over here is, so if you look into each of these variables, right, you will see that either I'm focusing on the reliability metric or I'm focusing on the affordability of the affordability metric of the borrower, because that's all I want to know. That is this borrower a reliable borrower, and is this borrower a kind of, so is this borrower a reliable borrower, and second is this borrower affordable borrower, right, for the product. So this is what we are basically going to look into. Now what happens is, now basis this, the business has a cutoff score. So the business says that, okay, now if I want to give a loan, right, so all I'm going to consider is borrowers who have positive current account balances, at least a positive current account balance of 0 to 20,000. So the minimum score that I'm going to give for this except for this category is 15. Anything below that, I'm not going to take it. Now for savings account balance, I need a borrower who has a moderate savings account balance at least between 10,000 to 50,000. Because if this guy has some amount in current account, he must also have a decent balance in savings account. Now, if he has decent balances in both these accounts, then I know that he is a affordable as well as reliable borrower. Now, the fixed obligation to income ratio between 0.1 to 0.5, that's 38. And the number of inquiries conducted by this customer for the product should not exceed 5, between 1 to 5. Right? Now, even 1 to 5 is more, but I'm just keeping that. Right? So now when I add these up, I get a total score of 107. So 107 is the cutoff score, right, given the criteria of the bank. Now, this is something interesting, right? So you see that the score that the bank has decided is based on the choice of certain criteria. Now, what if this guy is taking something which is different? If it's taking a value which is different. Let's say there's a downturn coming in, right? Now the bank can easily make it more conservative just by raising its criteria 2 notches up. It says that any guys who have a overdraft balance are not going to give the loans. I'm only going to give loans to those guys who do not have overdraft balance. So all he needs to do is he needs to just increase his score from 15 to 28, and the score cutoff will go up by 13 units. Right. So the guy who was previously being accepted may be rejected under a downturn. So this gives, or scorecards gives the banks a very flexible way of managing the risks, right? So over here, let's say Mr. A's credentials. Mr. A does not have a overdraft account, so it's 28. He has a balance between 0 to 10,000, so it's 21. So this is something which is below their expectations. Now he does not have any other credit, so he gets a score of 45, and he just made 2 inquiries, hence his score is 28, and hence the sum of these two is 22. So now let's assess the characteristic of Mr. A. So Mr. A is someone who does not have a overdraft account and does not have any fixed obligations to pay, and he has a moderate savings balance between 0 to $10,000, and he's just made 1 or 2 inquiries, right? So 2 inquiries about the product, and he's just taking that. So there was just one bank who had rejected him, not like, because they may be high end bank or something. So he's made just 2 inquiries for the product before taking it up. So therefore his total acquisition score is 122. So now is he accepted or rejected? Now if Mr. A's credential score is more than the cutoff score, then he is accepts or he is declined. So over here we can see that this guy is clearly accepted, right? Now the question that comes out is, so now when we move into the behavior scorecards, right, the type of variables that enter behavior scorecards are very different. Because in behavior scorecards, once you have given the loan to the borrower, all you are trying to do is you are trying to monitor and you are trying to identify the willingness of the borrower to pay back, right? So the type of variables that you are using to predict or to predict this probability of default is very different from the variables that you had used to capture these acquisition PD, right? Hence, comparing these two probability of defaults, so the behavior PD at acquisition and the PD at acquisition and the behavior PD in performance is a bit of a challenge because the nature also, so these two scores are not always comparable, right? So one reason is that these two scores or these two, you know, PDs, they use very different types of variables. So this and this uses very different kind of variables. Very different kind of variables. Uses very different kind of variables. Hence, comparing the scores of, hence comparing the PDs, right, and deciding the deterioration is very different, right? So it becomes very different. It becomes actually a very totally different ball game over here, right? So this is one of the big challenges of using behavior PD and acquisition PD, comparing the behavior and the acquisition PD to get different variables. I mean, to identify the significant increase in credit risk, because one, they use very different kind of variables. They focus on two different aspects of the borrower. Now, even if I accept that's pretty logical, there is another challenge. The biggest challenge between using this application behavior scorecard to assess the significant increase in credit risk is that both these two accounts, now both these two scorecards may be built upon different performance windows. So, as I say, the performance windows for application and behavior scorecards can be very different. So, performance windows may be different. Also, the bad definition may be different between these two variables, between these two scorecards. Performance windows and bad definitions can be very different between these two. Right? And the bad definition, performance windows and bad definitions can be very different between application scorecards and behavior scorecards. So application and behavior scorecards. Right? So application and behavior scorecards will have very different uh, performance windows and the bad definition. Now the question is, so basically let's quickly kind of talk about the concept of performance windows and the bad definition. Application and behavior scorecard may have differences. Hence, comparing these two may be very different. Hence comparing these two may not be absolutely consistent, and even if you are comparing them, there must be some recalibration exercises done, and it's a lot of complex. It's very complicated, right? So before I just move on, I'll just talk about the concept of a performance window. Now, the basic objective of making this IFRS9 models predictive, right? So for to make any model predictive, especially the scorecard models or the PD models, to make them predictive, we need to define something called a performance window. So the question that comes out here is, so what exactly is a performance window? Let's say I am standing today. So how do I make my model predictive first of all? Let's say I'm standing as on December, right? And I stand on the 22nd of December. Now standing on the 22nd of December, what I want to do is I want to know that in the next 12 months, what are the expected probability of defaults for my borrowers, right? So over here, the probability of default. So standing as on December, so as on December 2018, right? Standing here, I want to know that what is the probability of default? What is the PD? What is the PD in the next 12 months? In the next 12 months. So this next 12 months, or let's say, so this as on December 2018, so December 2018 becomes my observation month. So this is my observation month. And this next 12 months is my performance month. So next 12 months is my performance month. Performance months. So next 12 months is what? Jan 2019, say December 20. Now this is why I am actually predicting, right? So that I get to know the next 12 months what is the behavior like. So therefore, when I'm developing the model on the historical data, I have to do it such that these next 12 months behavior is maintained.
So, Tanmay, one quick question. The performance the performance window should be like pre-December 2018, right? This would be the performance window which will determine the future performance.
Right. So when you are developing the model, when we are developing our models, right? So we'll have it the history. Let's say I am using data from 2015 to 2018, right? 2015 Jan to 2018 December. So I choose a month, let's say 2015 March. So what will be the performance for 2015 March? The performance period over the period over which I'll look into the performance of an account will be what? It will be April 2015 to March 2016. So it will be like that, right?
Okay.
So next, when I choose as an observation month, say 2015 June, so it will be July 2015 to June 2016. So standing as on that month, you are looking into the behavior of the borrower. So that is what is called performance. So performance period, the concept of performance period enables you to make your model forward looking. Right? So what is like what is your question? So where are you
No,
getting confused
so yeah,
about?
yeah. So there are like performance window could differ for application scorecard and behavior
Yeah,
scorecard.
absolutely,
Yeah.
absolutely.
So suppose now application scorecard I'm developing, and for developing the application scorecard, I require some data to get the
uh,
cutoff score. So the cutoff
Correct.
score, so the data would be historical
Oh
data,
yes.
right?
So you
Yeah.
are building, so even if imagine that you are standing today and you want to know the behavior possible in the next 12 months. Next 12 months mean what are the probability of defaults? So you have to use whatever information you have up to December 2018, because Jan 2019 to December 2019 has still not occurred. And that is the basic concept of predictive modeling, right? So I need to develop a model which is forward looking in time. Correct.
Yeah,
So
correct, correct.
I'm standing here today and I want to know what are the probability of default in the next 12 months. So that is where the role of performance comes in, because the dependent variable that I had created was a forward-looking dependent variable creation, and that's how we create the bad definition, right? So we talked about that, right, in our
Yeah, yeah, yeah.
those in our CRM discussions, right? So I'll
So
come to
so
that. So yeah, tell me.
okay, so performance window, so performance months is always which will be predicted, right? In a way that you are telling them.
Yeah, so I develop my data such that I can predict the next 12 months. So that's my target variable, to
Yeah,
predict whether
correct.
the borrower turns out to be good or bad in the next 12 months. So that's my
Based,
performance.
yeah, based on the historical data which I have.
Right, right, right.
Okay. So performance window is always forward looking in a way.
Yeah.
Okay.
It's not in a way, it's a forward looking time period,
Okay. Okay. Okay.
right?
Thank you. Yeah.
Okay, great. Now, application scorecard and behavior scorecards may have different performance windows. Let's say I have developed the application scorecard on 18 months performance and behavior scorecard on 12 months of performance. So then comparing these two scores become very difficult, right? But still, you need to have some kind of an origination score. So how do you use that? So then how do we reconcile this difference? Now to reconcile that difference, we need to use something called the month on books, right? So that was the question that Nihal had asked sometimes back. That accounts. So let's say I have been originated in the books on uh, say October 30th, or say October 31st, 2018, right? So I have been originated on the books, right? So this was my account opening date. Now, after I have originated, right, it will take some time for me or for my deterioration to happen. Right? So, what I need to find out is that, so as on this date, I have a certain credit quality. right? So I have a certain PD. Now, after acquisition, right? So I start performing, I start paying back my loan. So up to certain point of time, the characteristic of the population or characteristic of the account from its acquisition up to and the characteristic of the population and the behavior of the account, right, at origination and at behavior is not very different. Let's say up to month on books, for month on books less than equal to 3, right, the acquisition PD, is identically equal to the behavior PD. So up to a certain point of time, these two PDs would be more or less similar to each other. That is, the characteristic of this account, right, within the first 2 3 months on books is not very different from what it was in acquisition, right? So we choose that behavior PD. So let's say the behavior PD of the borrower up to the first 3 months, up as a 3 months on books, becomes a proxy for my acquisition period. So what we need to do is to solve this problem, we need to find out this month on book through appropriate analysis. I need to find out this month on book value, right, up to which the acquisition PD and the behavior PD remains more or less similar. That is, not much significant behavioral change happens in the quality of the account from origination. So what it was in origination, it remains more or less similar. But that happens up to a certain point of time, certain point of month on books, right? So after it has been on the books of the bank, the borrower's riskiness changes. So I need to find out that point, that cutoff point up to which, the acquisition PD and the behavior risk PD remain more or less similar. Because after a certain amount of payment has been done, the risk characteristic of the behavior of the borrower changes. Then the acquisition PD and the behavior PD becomes very different from each other. Right. So now, given that this borrower is a very good borrower and he is paying back very nicely, so in that case, the behavior PD becomes more lower compared to what the acquisition PD was, and that's very distinct. So what we do is we generally find out that cutoff month up to which the acquisition PD and the behavior PD is more or less similar in each terms. In each, these two are very characteristically very similar. Clear? So is this part clear to us? So instead of using the acquisition PD, what we would do is we would say identify this. Let's say I see that up to the first 3 months on books, month on books equal to 3, my acquisition PD and behavior PD is more or less similar, right? So I use the PD that existed for the account as when the account was 3 months on books. That will be used as my acquisition PD, and the PD as on date today will be used as the behavior PD. Now if there is a certain percentage deterioration, I'll say yes, there has been a significant increase in the credit risk. Right? Questions? So Neha, does that answer your question now? Okay. Okay, I'll just explain this concept once again. So let's just use a very simple example. Let's say let's say there is an as on date. As on date. And there is an account opening date. So as on date shows right. So I have my acquisition period. And the other thing that I have is my behavior PD or simply my PD. Right? So over here, let's say the as on date is 31st Jan 2018. Right? Okay. Now the next part is the account opening date. Now when I talk about the account opening date, so what is this account opening date? Account opening date, let's say it is December, November, October. Let's say it is so let it be 36 28 27. Right. So in 6 months, the PD of the borrower now is say 0.03%. Now I want to have the acquisition PD. So one choice is I can use the acquisition PD that I had generated as on this date, right? But if I do that, the problem is that acquisition scorecard was developed on a totally separate set of variables. And the behavior scorecard is developed on a totally separate set of variables. So there you have the distinction. Questions that come out over here is that how do we do this, or what do we do over here? So then what I do is I see that okay, within the next 3 months, now this cut of 3 months, months on books equal to 3 or greater less than 3 greater than 3 is something which is to be decided, right? So that has to identify the appropriate analysis. Let's see that I see that okay, for accounts which are month on books equal to 3, the acquisition PD is equal to your behavior PD, right? Now comes the question over here. So what is the question? So what I say is okay, what I look into is my behavior PD as on 39/2018. So 39/2018's behavior PD is equivalent to the acquisition PD at or as on 30/06/2018. right? So this is what the idea is. So what I'll do is I'll use the behavior PD as on this date, because what I've seen through my analysis is that for the first 3 months, right, the quality of the borrower's PD is not significantly different from the riskiness that he had at the time of acquisition, right? So it says that over here it was, let's say it is 0.02%. And now, as on 31/1/2018, so 6 months down the line, you have 0.03. So you can say that yes, the behavior PD now is more than the acquisition PD, and hence there is a deterioration. So what we need to do is we need to compute the relative deterioration percentage. The relative deterioration.
Tanmoy, I have a question here.
Yeah,
Before
tell
we
me.
go into relative deterioration,
Uh-huh.
so when you talk about
Uh-huh.
like 3 months, 6 months, so this difference in the acquisition PD and the behavioral PD that you observe across three
Uh-huh.
months or 6 month time period, this
Uh-huh.
time period is not consistent for all set of all accounts, right? This would be like different for
No, this
it
will
would
be
be
at a
individual
portfolio
to each.
level. No, 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 no.
Oh,
This
it
will
would be
be at a portfolio level. Because when you are
okay,
developing the model, you are developing the model at a segment level, right?
right?
So
No,
that cutoff will be at a segment level. Now, mostly, generally, what you see is that for a given segment, the accounts take a typical time to mature, right?
right.
So this month on books that you will put, this cutoff will be segment specific. It will not be account specific. Otherwise, it will be too volatile something, right? So you'll not have anything. So I mean, you'll not have any definite pattern, right? So if you cannot do that, the maturity of an account at each level. So you have to look into it from a perspective at a segment level. So accounts in this segment remains insignificantly different characteristically, or characteristically they are not very different from acquisition for the next 3 months, right? So even for if you look across different kinds of model segments, you'll get at least 2 to 3 months itself. Now after that, once you start making payment for 1 or 2 quarters, your it's you more or less start, your PD starts changing, right? Your behavior starts getting gradually displayed, and after you have done it for more or less for 12 to 13 months, you become a seasoned account. So in that way, it's more or less around 3. So basically, the model that I have worked on, the retail models, I've seen that for almost all the segments, it was around 3 itself. But yes, this MOB will be computed at a segment level,
Great,
depending on the
thank you.
riskiness. Yeah. So the relative, we compute the relative deterioration. The relative deterioration will be your 0.03% minus 0.02% divided by 0.02%. So that's the relative deterioration. So when once you see that this deterioration happens, or once you compute this deterioration, you know that yes, there has been a certain deterioration, and then if this relative deterioration is greater than 0, you will say yes, there has been a significant increase in the credit risk. Right? So is this part clear? So just by by doing this small analysis, just by identifying the time over which the acquisition quality on the whole remains unchanged, or more or less remains unchanged, right? You can actually identify, yes, this borrower, or you can actually solve this problem of differences between acquisition and behavior PD, and you can use that acquisition, the relative difference between acquisition and behavior PD, as a criteria for so you can use it as a criteria for your significant increasing credit risk. Clear? Okay, so over here on this note, let's take a break, right? So it's 10:45 by my watch now. Let's meet up in the next 15 minutes, right? Because I've been talking for quite some time. So just a 10-15 minutes break and we'll get started. Right? So we'll just meet up in the next 15 minutes. So thank you guys. Thank you for your time and let's get back at it. Thank you.
This conference will now be recorded.
Okay. So as I was saying, yeah. So we looked into the challenges that can be posed if we are to compare the acquisition PD and the behavior PD, and we explored the reasons as to why the differences are there. Right now, the next part that comes in is that how do we solve that? So we can solve that by looking out for a cutoff time period between which the acquisition behavior and the acquisition PD and the behavior PD are not very different, right? So we use that. Say let's for example say for month on books equal to 3, the behavior PD is the behavior PD which is there. So we use that to kind of impute this particular role of acquisition PD. And then we compute the relative deterioration. If the relative deterioration is something which is greater than 0, we know that yes, there has been a significant increase in the credit risk. So this is one way of defining SICR. Now the second way of defining SICR is that if a borrower moves from being a non-delinquent borrower to a delinquent borrower, right? So if there is an instance of a rollover to delinquency, then it is considered as a significant increase in credit risk, right? Now, when I talk about rollover to delinquency, what do I mean? When I say rollover to delinquency, what I mean is if a borrower becomes as simple as that, as 30 days past due. The moment a borrower goes 30 DPD, right, it becomes one cycle delinquent. That is, it rolls over from being a CD0 to a CD1, right? Then it is called a, so if it rolls over from being a CD0 to a CD1, then this is called a significant increase in credit risk. If a current borrower becomes a delinquent borrower, then you know that this borrower is a CD or he has become 30 days past due. So if he has become 30 days past due, 30 DPD, then you say that okay, this borrower has undergone a significant increase in credit risk. So this is another SICR criteria, significant increase in credit risk criteria, or as we can call it, it's a staging criteria. Right now there can be other criterias which follow, right? So what are the other criteria? The other criteria can be a high risk account management criteria. Let's say if the strategic team or the account management team identifies a particular account as a significant increase in credit risk, or as say let's say the account management team identifies or flags an account as a high risk account, right? Then you know that the account has undergone a significant increase in credit risk. So it could be one of these criteria, or it could be a combination of many of these criteria, or it could be a or. So if the acquisition PD is greater than the behavior, the behavior PD is greater than the acquisition PD, or the account goes 30 days past due, or the HRAM or the HR, the high risk account management, or the account management has flagged an account as a high risk account, then either one of these conditions is satisfied, then the account is migrated from stage 1 to stage 2, which means that now the borrower is not a defaulter, but his chances of defaulting has increased. And when that happens, it's moved to stage 2, and in stage 2, you compute or you report the lifetime expected losses corresponding to the account, right? So this is precisely how a staging analysis is done. Now, if from being a delinquent borrower it further deteriorates and it comes down to stage 3, then it becomes an impaired account, right? So these are what role does this particular staging actually play? The role that this particular staging plays is uh, the role that this particular staging exercise plays is very so how do I put it? Yeah, so this goes into make the model very predictive or preemptive in nature. So you are not only looking into the next 12 months or its probability to default or loss given default in the next 12 months or something like that, but you are monitoring him on a stage by stage basis the deterioration in his behavior. So you are being that granular in your analysis, right? So this is where the staging criteria plays a very critical role in IFRS 9 in making it more predictive in nature, right? So now with the staging exercises, once you have staged your accounts, the next and the most important part that comes out is to make your model or is to compute your ECLs. And for ECLs, you have these two broad concepts of next 12 months ECL and your lifetime ECL. If you talk about ECL over here, you have next 12 months. Next 12 months. And over here you have lifetime. Right? So now the next question that we need to address over here is that how do we calculate these? So how are these modeled? Now, modeling ECL is the crux or is the core of IFRS 9. So now if you want to model this, we need to understand some very critical concepts, right? So to talk about ECL and all. So the next set of discussions that we take up over today and the whole of tomorrow would be focused around developing this ECL or exploring the components and the nature of this ECL, right? So how do we go about computing this? How do we go about computing a lifetime ECL? How do we go about computing the next 12 months ECL? Then once that is done, then we'll segregate out their components, PD, LGD, EAD, and we look into that how is PD important, how is LGD important, how is EAD important, and so on. So what are the assumptions that go into computing them? What are the characteristics that go into computing them, and so on, right? So we will be working around those parts as well. So let's start with this concept of expected credit losses. Now, so talking about expected credit losses, expected credit loss is defined as a product of PD or the probability of a borrower to default into the loss given default, which is the LGD, into the exposure at default or the EAD, right? So this is called, yeah,
I have one question, Tanmay. When we say
yeah,
like exposure, when we say like exposure, does it mean like the outstanding balance at default, the remaining which is
right,
not being paid by the
right.
customer to the bank?
Correct. So that will also include, interest. It would include the principal, unpaid principal. It would include, if there are interest like fees and charges, everything added. Whatever is the outstanding amount, that is your exposure.
Okay.
So it's precisely your outstanding balance. Now the EAT becomes more dynamic when we are talking about revolving products. When we are talking about revolving products, because over there you have a certain credit conversion factor, right? So I'll come to that. I'll come to each of the definitions. Now over here, PD stands for the probability of default, right? And when this part, when we talk about this, the PD is divided into two parts. Piyush, can you be on mute, please? So there's a background noise coming in. Thank you. So over here we have the next two things. One is the next 12 months. No problem, Piyush. No need to apologize. It's a mistake that anyone can do. So it's perfectly fine. So over here, what we have is the next 12 months of losses. So I need to compute the next 12 months PD. PD. And the second concept that we have over here is the lifetime PD. The lifetime PD. So these are the two dependent variables, right? Now, something important is there when I talk about PD. Now, IFRS 9 talks about a PD which has two characteristics. So these two PDs that we have talked about, the next 12 months of the lifetime PD, will have the following characteristics. So we need to, kind of have some of these features. I mean, each of these two PDs need to have certain characteristics. So the first point thing that we have over here is that it must be a point in time PD. A point in time PD. Must have a point in time PD. And the next thing that we have over here is that it must be a forward looking PD. Must be a forward-looking estimate. Now, when I say it is a point in time PD and it has to be a forward-looking estimate, the question that comes out over here is that are these two concepts connected? So how is it that I can make my uh, how is it that how is it that I can make my PD point in time, as well as how is it can I make this forward looking in nature. So in order to bring these two together, what I need to do is I need to have my point in, so I need to uh, so basically what it says is that the PD must be made sensitive to time. So basically with time something changes, the PD should also change, and it should be a forward looking estimate. And these two are connected by a concept called the macroeconomic scenarios or macroeconomic variables, right? So basically, this is another very important contribution that IFRS 9 has, which was not there in Basel, because Basel used to look into, was talking about looking through the cycle PD, which is a long run conservative estimate of a probability of default, right? So the point in time estimate and forward looking estimate over here is is connected with a macroeconomic scenarios and macroeconomic variables. So it says that you need to do macroeconomic adjustments or adjustments to macroeconomic variables, right? And from there, you can actually have a and you will give me a point in time PD. So this is a PD which is generated macroeconomic variable. So this is where the macroeconomic the role of macroeconomic variables come in, right? So over here I have point in time and I have forward looking estimates, right? So over here from now I can make my PD estimate a point in time and forward looking in nature by adjusting it to macroeconomic variables, right? Because generally when we develop PD models, PD model is a behavioral model and mostly contains behavioral risk factors. It does not factor in the macroeconomic variables. Now that PD model, so if you have a behavior model for your portfolio, you need to adjust that to a macroeconomic model to get your point in time forward looking PDs. And once you have your forward looking PDs, you should also be in a position to convert it back to through the cycle PDs. So we'll come to all these concepts in details, right? So I'm just laying out the frameworks first. Okay, so before I move on, Piyush has a question over here. So he asks that could you please explain point in time versus long run average TTC? I'll come to that description, Piyush, in a short while. I'll just come back to that. Okay, so the first question that comes out is, so the question that Piyush actually asked is a very relevant question, that what exactly the difference between a point in time and a through the cycle PD, right? And why is it that while Basel talks about TTC-PD, why is it that IFRS 9 talks about a point in time PD? Now, to explain this difference, right? So let me just start by talking about a point in time PD, point in time and a TTC-PD. And from there, we will go ahead and we'll be talking about that why IFRS 9 is talking about a point in time PD, when Basel talks about TTC PD. Now, IFRS 9 as a regulation. So, IFRS 9 as a regulation is something which is focused on provisioning, right? And provisioning enters the P&L account. So, what? So, because IFRS 9 works with provision. So, let me just create the flow. provision, right? Therefore, its impact is on the P&L statement. The profit and loss statement. Profit and loss, right? So the provisioning impacts is on, so it impacts the profit and loss statement. Now, if it impacts the P&L, so I cannot, so I have to ensure that. So my P&L is computed every year, right? And there is something that from this P&L statement, so basis the P&L statement, what I generally do is I would be giving out, so my profits, or from this P&L I'll get my net profit, right? So the final output of P&L statement is net profits. Now I have to make, and this is the reason why the net pi stands for profit, right? So if I have to give the profit, I mean, if I have to calculate profits from here, I'll have to have a provisioning estimate which is sensitive to macroeconomic situations, because provisionings are sensitive to the state of the economy. So if today a downturn comes in, right, the provisioning tomorrow will go up. On the other hand, if I'm going through a good period of time, the provision that I will be keeping, or the provision that I'll be facing, will actually be very less, or it would be relatively lower. Therefore, what we would generally do over here is we would kind of try to put this profit and loss. So basically, this is the reason why your provisions has to be made kind of sensitive to your macroeconomic situations, and hence during a good period of time the PIT should be low, during a bad period it should go up. So if my forecasts are that the next 12 months the period is going to be bad, then I should already have an idea that okay, in the next 12 months this is the amount of provision that I need to keep. So provisioning is very sensitive, or the amount of provisions that we keep is actually sensitive to the I mean, to the macroeconomic scenarios that we have in our model, or the macroeconomic scenarios around us. And hence, what we need to do is we need to ensure that these provisions are sensitive to the macroeconomic situations, and hence the way I'm calculating this should contain a PD measure, or the a default, a probability of default measure, which is sensitive to macroeconomic situations. Hence, the choice of the estimate is the PIT. So PIT is the choice of the estimate. I mean, hence PIT, or the point in time PD, is the I mean, that is the chosen PD, right? So So when I talk about provisioning, so what happens in this provision? Sorry, just let me rephrase that. Now, provisioning is sensitive to movements in macro variables, to macro movements. to macro movements. Hence PIT. Hence PIT PD. Right? So this is precisely why we use point in time PD. And what is point in time PD? It changes with changes in macroeconomic scenario. Now let's have a look into Basel. Basel. Now, why would Basel demand or why would Basel have a TTCP? Now, why is Basel used? It is used for capital adequacy. It is done for capital adequacy. And what is the target variable for Basel, or what is Basel actually trying to do? Basel is trying to absorb the unexpected losses. So using this capital adequacy, it is trying to absorb the UA. Absorb the unexpected loss. Will absorb the unexpected loss. Now, if you are absorbing the unexpected loss, what is that capital tier using which you are absorbing it? You are absorbing it using the tier 1 capital, right? Let's just give me a second. Okay, so this unexpected losses are absorbed using the tier 1, right? Now, if you have a look into this, so I have so what is this tier 1 capital comprising of? Tier 1 capital comprises of your equity, right? Now, let's say I use a point in time PD, right, for capital allocation. So what would happen when a downturn period is forecasted? I say, okay, I require more amount of capital now. So what will I do? I will have to raise my equity. And how do I raise my equity? Through public, like public declaration, through IPOs or public offerings, right? So that's how I increase my equity. So now imagine that a bank comes out every now and then and talks about public offerings. So what signal would it actually send to the market? That this bank is not actually capitalized, and whenever small ups and downs happen, they go and raise their capital, right? So in this case, So in this case, what we have is equity. So given that I have to raise a capital and I need to keep myself adequately capitalized, be it from by reaping in profits from within my business or be it by raising IPOs, I mean through public offerings, whatever it is, I need to ensure that I have sufficient amount of capital and I have to calculate it such that, or I have to raise my capital such that it is adequately raised, right? And that there is not much of volatility in that. So therefore, the PD estimate that I need to choose has to be a fairly conservative PD estimate. A PD estimate which takes into account or which is independent of movements or small fluctuations in cyclical movements in the macro variables. So I need to compute my PD such that it is a long run estimate of the PD by considering a long period of data, right? So that PD has to be a fairly conservative PD. Will have to be a fairly conservative PD, right? And this conservative PD is a long run PD. It's a long run. Now, this PD is not impacted by cyclical fluctuations. Why? Because this PD already considers a long vintage of data. So it considers a large vintage of data. It considers a whole or a full business cycle. A full business cycle, right? Hence, this PD estimate is more conservative. It contains a whole business cycle, so you have actually considered a long period of data, right? And hence, this PD is relatively higher than the point in time PD and is independent of the different states of macroeconomic situation. So this is your Vasicek's PD. This is your Vasicek's, your Vasicek's, right? So that is the reason why IFRS 9 uses point in time PDs, whereas Basel uses long run TTC PDs. And the sole and one of the very important results which helps us calibrate across these two groups of PDs is the Vasicek's transformation or the Vasicek's model, right? So that's what we call Vasicek's PD model, right? Which will be obviously a very critical part of the discussion. But at a very high level, this is the difference between your IFRS 9 and your Basel models.
May I ask question?
Yeah, sure. Please go ahead.
When we say business cycle, is it like 7 or 10 years of data that we get?
Like generally for developing a Basel model, what Basel says is that as per the Basel requirement, you need to have a minimum of 5 years of data, including a downturn, right? But when the banks who develop Basel, they generally tend to have sufficient vintage of data, right? So let's say 10 years data. And all. So it is always typical. I mean, it's always good that if you develop the model with 10 years of data. Now it depends on how at what time you get your downturn periods, because let's say that I want to use 2008, right, as a downturn, because that's a typical case of a stressed downturn period. Now, I cannot start my data from 2008 because otherwise that will be a biased model. So what it requires is that your data should include a downturn. What it means is during downturns, what will happen is that default rates will go up, right? So the model, the data period that you use should include that downturn. By including the downturn, it means that so what it means is this. So this is 0, this is time, and this is the default rates. This is the default rates. So over here, say it, your default rates increase and then they again go down. So this is your typical downturn period, right? So you have included the downturn. So your downturn is preceded by a normal period and succeeded by another normal period. So this is what it means is including a downturn. So ideally you cannot start from a downturn because it will something look like this, or you can end with a downturn, otherwise the distribution default rate will get skewed, unnecessarily skewed, and that will end up with a biased model. So this is precisely what we mean by including a downturn. So if I am to include 2008, I must have at least 2 years of data before that. So we generally start from 2006 and then we go on till say 2016, 2018, whatever data points we have. But as time goes on, right, so as we proceed with forward in time, we'll see that this is kind of, you know, so as we proceed forward in time, we'll see that 2008 becomes more and more farther away from the time points, and then they will not be within the time point. So it is not important that you take up a global financial crisis. All you need to do is to include a downturn where your bad rates are spiked up. Let's say for Middle East, the downturn period was 2015. The third quarter, say it was up to the end of 2017, right, or 2017 last quarter. So that period will be a downturn. So we need to start with data at least from 2014, then go until with data 2018. Within these 5 years, you have some months which includes a downturn. So that in the PD that you compute, right, you will be considering one whole business cycle, and this consideration itself will make the model or make the PD estimate a conservative one, right? So this is why the PD estimates are used the way they are. Right?
When we say like a model is a point in time, so can we say like our behavior, the model, I mean the behavior model that we build, is it a point in time?
Yeah, they are point in time. They are point in time. And so what we often do is we use these behavior models, the behavior PDs, and make them into IFRS9 PDs by adjusting the macroeconomic variables. Or if you have your Basel TTC PDs, you convert them using the Basic transformation into point in time and then adjust it to macroeconomic variables. Or what it may happen is you may have your Basel models, you get your PDs from there, and that you convert it into your IFRS, into your point in time PDs, right?
Just last question. I am
Yeah.
not sure what is calibration and why do we use it?
So calibration is a very fancy word used for transformations, right? So basically, I have a TTCPD, which is adjusted for macroeconomic variables. Now, what if I had a if I had a PD which was not adjusted to these macroeconomic variables? How will I use that? So then I need to adjust for that, right? I need to do some kind of an adjustment and get one into another. So similarly, let's say for example, we talk about dollar to INR, right? So what we do is we calibrate dollars to INR. So that conversion you convert it to a common scale using some multiple, some factor, something. So that is called calibration.
Okay. Thank you.
Like say for example, you get behavior PDs, right? So what we do is then every organization has its own rating scales. So they create PD ratings or PD, PD cutoffs, and corresponding to each they have their own ordinal scales, their internal ordinal scales, right? So that is what we generate. So that is what is calibration. So when you are converting a set of values from one form to another form such that they are comparable. Right? You cannot actually compare a TTC-PD and a point-in-time PD. So once you can do that once you have calibrated that. Right. So for example, the acquisition PD case that we saw, right, and we used the behavior PD 3 months. So that was again an example of a calibration. So in a calibration, we are converting from one form to another form.
This long run PD will generally be more greater than the point in time PD, right?
Yeah, yeah. So it's more conservative than the point in time PD.
So PD would be higher in a way here.
Correct. It will be higher in
Okay.
that.
Because the time factor is there here.
Yeah, so you are actually considering the downturn also, right? So the moment you consider downturn, obviously your PD goes up.
And point in time considers only 1 year data.
No, not necessarily 1 year data. So it contains a smaller time frame. It
Okay.
contains, or you can say that it considers the most recent
Recent.
risk behavior,
Okay. Thank you.
right? Okay, perfect. Okay, so let's do something. Let's stop here for the day, right? So there has been a lot of different discussions. So we'll pick it up. We'll pick up the PD fresh from tomorrow, right? So that we'll talk about quantitative PDs, we'll talk about long run PDs, we'll talk about macroeconomic adjustments and so on. And then, so we'll complete the entire PD part in tomorrow's discussion where I'll talk about the ASIC PD as well.
Just last question,
Yeah, yes.
Naveen.
Tell me.
Like when we build any Basel model, right? As I've seen in like, so after like 6 months or 7 months, why do they recalibrate? Because the model.
Because, yeah, so what happens is the see the portfolio keeps on changing every time, right? So what
Mhm.
happens is that the log of odds that you had at the time of development may shift. The moment your log of odds will shift because of a shift in your portfolio, the overall accuracy of the model will also shift. So what you do is you just check that over the last few months, what was the discrepancy between the actual and the expected loss calculation, the actual expected figure, and you just add back that difference and you just rerun the regression and just recalibrate the coefficients so that the regression equation is adjusted to the estimates to the shift in the small shifts in the actual default rates.
But we do not change any population, right? The data remains
No,
same, but we only
no, no,
adjust
no.
the.
See, the data is the most recent data. So
Hmm.
calibration or recalibration is a part of the model monitoring exercises. So after your model has been implemented and it's running, the portfolio keeps on changing, right?
Hmm.
So the log of odds may shift. So that is just recalibrated back. We'll talk about recalibration when we get into model monitoring. I'll come to it.
Thank you.
So we will come to this when we talk about actual expected losses and so on. Right? Okay. So thank you guys. Thank you. Thanks a lot for your time. Right? So I think we had a very comprehensive discussion today. Right? So it's just that I got stuck in between. But nonetheless, we had a lot of different discussion, and tomorrow I hope to have a more technical discussion around PD, Vasishek and all. So this is going to take a more quantitative edge over the next few discussions. Thank you guys. Thanks Piyush. Thanks Umang. Thanks Toon. Thanks Pradeep, Anshul, everyone for your time. Have a great weekend, and let's catch up tomorrow following this Christmas, New Year. Have a blast for the next week. Bye bye.